Whether you trade stocks, ETFs or currencies, every trader needs a plan that tells you when to enter and exit a trade to make a profit. Welcome to the last of a 4-part series to show you how to use Theta 45 to create a trading plan. While day traders can be profitable using Theta 45 alone, knowing what drives the price of a stock on a daily basis increases the confidence in the technical analysis. In this episode, we're going to focus on stocks only. The stock price for a specific company has a long-term trend that depends on the persistent outlook of that business by the market. As a trader or investor, you buy a share of that company at the prevailing market price. As a shareholder, you are entitled to your proportion of the free cash flow generated by the company. The demand for shares will be greater for a company that generates increasing cash flows year on year, increasing its share price. Conversely, a company losing cash will have less demand for its shares, decreasing its share price. The share price can also be manipulated from the supply side when the company either issues new shares, which drops the price, or buys back its own shares, which increases the price in the market. But the primary factor that drives the demand for a stock is the free cash flow the company can generate. Cash comes into a company in the form of sales. A healthy company will have increasing sales year on year. But the company has to spend cash to manufacture its products or to deliver its services. Taking an airline company as an example, these costs include labor, airline fuel, and aircraft maintenance. Subtracting these items from the cash received in sales gives us the gross profit. To generate the sales and support the business, a company also has SG&A expenses that include marketing, airport fees, and sales commissions. Subtracting these costs from the gross profit gives us the operational profit. A large company runs on debt and will have to pay interest expense every year. A company with spare cash, or a company who have to hedge against expenses that fluctuate in price, may also have to invest in financial securities that earn interest every year. This net finance expenditure is deducted from the operational profit to calculate the profit before tax. A company then has to pay the prevailing corporation tax in the jurisdiction in which it is registered. Deducting that gives us the company's net income. The net income is the cash generated from sales. But the company has other items on its balance sheet that can be converted into cash. The balance from the cash from operating activities, such as depreciation and amortization, inventory, and accounts payable, need to be accounted and added back to the net income to calculate the operating cash flow. Finally, for a company to grow and adapt to the challenges of the future, money needs to be invested in assets. Money can also be earned with the disposal of assets. The actual free cash flow is calculated by deducting the net capital expenditure from the operating cash flow. While the market has a medium to long-term outlook on the free cash flow a company will generate in the future, any daily news that goes for or against those market expectations will drive the price of the stock in the short term. This could be information that directly impacts the revenue or cost of the company alone, or news that impacts the local economy and therefore the market as a whole, or information that has an impact on the whole world, such as a global pandemic or war. Speaking of which, a global pandemic can cause an unexpected drop in flights, dropping the stock price. The cost of goods sold can take an unexpected turn for the worse if there is a spike in the oil price. Inflation can increase the cost of marketing, or airports can decide to increase their fees. And if a rise in interest rates is unexpectedly announced, the cost of financing can also increase. Cash flow can also be reduced if the corporation tax increases, all of which decreases demand for this stock, dropping its price in the market. Conversely, demand for the stock increases if sales improve, or if the costs of the company are reduced. Day traders need to be aware of any such news announced each day about the company they are trading. For example, don't expect the price to come down on the day that a company announces an unexpected rise in net income. If you missed the trend going upward, either short sell at the top or wait for the price to settle or come down before buying. This is just one example of what makes a good trading plan. Subscribe to this channel as we will produce more videos on how to use Theta 45 to be a successful day trader.